Chris Parks here at McLean Mortgage, hoping to help you demystify a little bit today the whole issue around student loans. Student loans tend to be a concern for a lot of people. It tends to be the epidemic of our days, sadly. There are a lot of people who have a fair amount of debt when it comes to student loans. So I'm going to share with you today how the different agencies look at student loans and what calculation they force us to use, so that when you come and talk to me or you talk to another loan officer, you have a pretty good idea of what student loans are going to be required. So in order to make that happen, I'm going to go ahead and share my screen so that you can see the information firsthand. Now, this is information that we put together in-house over at McLean Mortgage, which is where I'm at as far as a lender. Happy to help you out. If you have any specific questions, don't hesitate to give me a call. My information is on the website that you just clicked on and saw this information for. Now, student loans. You can see that there are a variety of loan programs that are used. Now, these are the most common ones out on the market. These are called conforming loans. Now, there are alternative loans that are designed specifically for other people. For example, alternative loans out there could be a doctor loan. They could be a medical professional loan. Those types of loans do exist for certain categories of people, and they have slightly different takes on student loans than what these are. But this is for the vast majority of the people out there. This is what you're going to be encountering when it comes to student loans. So when you're looking at the Fannie Mae program and the Freddie Mac program, which are the conforming conventional loans. So in other words, when you're talking about conforming, you're going to be looking at Fannie Mae or Freddie Mac. They have the guidelines for what all the banks have to conform to if they want to get repeatable money from the treasuries and also from the Fed in order to be able to fund your loan. Now, if they have enough money in-house, which most banks don't, they have to borrow from the Fed or from the treasury to make this work. They have to conform to these guidelines in order to make it work, okay? So if there is a payment on the credit report, you can see right here, then what they're going to require right here is in Fannie Mae actually has the loosest of all requirements when it comes to student loans. With the student loans, they're only going to show whatever's on the credit report. Now, if you have zero on there, then we have to prove that there is a income-driven payment at this point in time that is actually zero. And we have to provide the actual documentation in order to be able to use that. Now, most commonly, we would have to verify what that is. And if it is zero, they're going to have a hard time letting you get away with zero payments on this thing. They're going to have a calculation that they're going to make this work. And in deferment, this is kind of what they're going to be using when we get into deferment. They're going to use 1% of the outstanding balance to identify what your monthly payment is going to be, especially if the loans are in deferment, or if you're just kind of waiting for that next season to arrive, we use 1%. So it's best in this case to, Fannie Mae has the loosest category when it comes to this, is try to get something showing on your credit report. And if you have above a 700 credit score, this is a really good way to go. Freddie Mac is a little bit different. They will go with whatever's on the credit report. If nothing is showing on their credit report, they're going to require 0.5% of whatever it is. So what that means is on, let's say if you have, just to use round numbers, a $100,000 loan, 1% would be 1,000, 0.5% would be 500,000, would be 1,000, 100, let me start over. So on 100,000, 1% would be $1,000 a month. On 100,000, with the 0.5%, you would be looking at $500 per month. So that's still a pretty hefty payment. Now, if you don't have a payment and it's in deferral, you're going to notice right there that they're in the 1% mode again. Now, the good news about both of these is if you're within 10 months of paying them off, we don't even have to use monthly payment. Now, obviously, that's a fair amount. Now, where you get into the great divide is when you go into what are called the government loans, which is everything else from there below. Everything above this is conforming. Everything below this is considered to be a government loan. In the government loans, you're going to find that they have very similar requirements, and they're actually pretty hefty requirements because they're looking forward. They're making terms easier for you to try to get into a house, but at the same point in time in doing that, they want to make sure that you're going to be able to repay this loan from the house. And so what they're going to be doing here is making sure that you have the available funds to make this work. So saying that means that they're going to require that you have the greater of, in most cases, of 1% or whatever is showing on the monthly payment. And so what that means is if your monthly payment is more than 1%, so using the $100,000 version again, just to use round numbers, 100,000, 1% would be $1,000, okay? If your student loans are more than $1,000, then we're going to use whatever that is. But if they're less than $1,000, we're using $1,000. And that pretty much applies to most of the loans out there when it comes to government loans. USDA has the same exact one. The VA is slightly different than that. They have a setting where if your student loan is scheduled to go into repayment within the next 12 months, we have to use this real complex algorithm. Other than that, we can use whatever's on the credit report, which is kind of nice. Now, if you're in deferral or something else like that, we have to go through a grader of once again. But most of the time, we're going to be running into this one right here, which is for the FHA, which is the greater of 1% or the outstanding balance. So student loans can be complex. They can knock you out of contention many times. So here's a real quick tip. If your credit is a little bit rough and you have a fair amount of student loans, it's a good idea to get your credit up so that we can get you into one of these Fannie Mae programs. That way you can make sure that you're able to qualify. So that may mean that you have to wait a little bit, but it certainly will also mean that you can buy more house. Hope that helps for you. This is Chris Parks once again with McLean Mortgage. So glad that you're able to share a little bit of time and share with you how the student loans work. Thanks so much. Bye.